Microcredit set out to free the poor from moneylenders with tiny loans, yet scaling the model produced over-indebtedness and borrower distress in Andhra Pradesh and beyond. This is Unintended Consequences, Episode 82. In October 2010, police in Andhra Pradesh began receiving reports of borrowers who had taken their own lives after repeated visits from microfinance collection agents. The loans in question were often no larger than a few $100s, extended by institutions that had once operated under the banner of social uplift. What began as a deliberate effort to bypass exploitative village lenders had, within a generation, generated its own forms of pressure. Mohammed Yunus, an economics professor at Chittagong University, began experimenting with small-scale lending in the village of Jobra, Bangladesh in 1976. He observed that local women making bamboo furniture or selling vegetables were trapped by moneylenders charging rates that could exceed 100% annually. Yunus reasoned that providing collateral-free loans of a few dollars at modest interest would let borrowers retain more of their earnings and gradually build assets. The approach aligned with the post-independence emphasis in South Asia on reaching populations that formal banks had long ignored. By 1983, the project had become Grameen Bank, operating under a charter that treated repayment discipline and group accountability as tools for both financial sustainability and social cohesion. At the time, the model appeared to square a difficult circle. It offered market-based credit without requiring the heavy subsidies or state bureaucracies that had characterized earlier rural development programs. A woman borrowing the equivalent of $10 or $15 to buy raw bamboo or vegetables could, after repaying the loan plus interest at 20 or 30% a year, keep enough of the margin to cover household needs and still have a small surplus for the next cycle. The joint liability group of 5 or 6 neighbors supplied the missing collateral. If one member missed a weekly installment, the others faced pressure to cover it, turning social ties into an enforcement mechanism that kept default rates low without formal assets. Yunus and his colleagues viewed this structure as an improvement over both the informal lender's extractive rates and the distant, paperwork-heavy commercial bank that would never reach a landless woman in the first place. Grameen Bank's joint liability groups spread quickly through Bangladesh and by the mid-1990s inspired replications across India, Latin America, and parts of Africa. Early repayment rates above 95% drew praise from donors and governments. The 2006 Nobel Peace Prize awarded to Yunus and the bank cemented the view that microcredit could serve as a scalable, self-financing route out of poverty. Commercial entrants soon followed. In India, SKS Microfinance converted from nonprofit to for-profit status in 2005 and raised hundreds of millions through equity and eventual IPO. Similar shifts occurred at Compartamos in Mexico and elsewhere. Proponents argued that private capital would expand outreach far beyond what donor-funded programs could achieve. A few observers noted that rapid growth might erode the close borrower-lender relationships that had supported high repayment in the original model. Yet the dominant narrative remained one of expanding access. The transition from donor-funded pilots to equity-backed growth altered the daily mechanics of lending. Where a Grameen field officer once managed a few hundred clients in a single village cluster, commercial loan officers in Andhra Pradesh were expected to disburse thousands of loans per month to meet quarterly targets. The same group liability form persisted on paper, but the officers' compensation now hinged on new disbursements rather than on the long-term health of existing groups. Borrowers who had once been visited weekly by someone who knew their household cash flows were increasingly served by agents whose performance metrics rewarded volume. By 2010, Andhra Pradesh alone counted roughly 17 million microfinance accounts against a population of about 84 million, with some households holding multiple loans from competing lenders. Portfolio growth had outpaced both regulatory oversight and borrowers' capacity to generate consistent cash flow from the small businesses the loans were meant to support. Collection practices intensified. Agents sometimes arrived in groups or used public shaming to enforce weekly installments. Reports documented cases in which women borrowed from one microfinance institution to repay another, creating chains of debt whose total service costs exceeded earlier moneylender burdens once all fees were counted. Randomized evaluations conducted by researchers including Abhijit Banerjee, Esther Duflo, and others in Hyderabad and elsewhere found that access to microcredit increased business starts and durable goods purchases, but produced no statistically detectable average gains in household consumption, health, or education within the first 18 to 36 months. The joint liability mechanism, intended to substitute for collateral, also transmitted repayment stress across neighbors when one member fell behind. As profit-seeking lenders entered, underwriting standards loosened because loan officers were compensated on disbursement volume rather than long-term repayment quality. The result was not a simple reversal of the original intention, but a second-order effect. The very feature that made microcredit appear low risk at small scale, high repayment discipline, became a source of rigidity once volumes grew and incentives changed. The causal chain ran through several linked steps. First, the visible success of early programs, high repayment, and visible small business activity drew new capital and new entrants. Second, those entrants competed for the same pool of borrowers who already had one or two loans. So the marginal borrower received an additional obligation whose repayment schedule did not align with the seasonal or irregular income from vending or weaving. Third, when a borrower missed a payment, the group liability rule required neighbors to cover it or risk losing their own access. This created immediate social pressure that could escalate into harassment when multiple lenders arrived on the same day. The randomized trials captured this dynamic by comparing villages that received microcredit branches with those that did not. While some households used the new credit to expand an existing enterprise, many others used it for consumption smoothing or debt rollover, and the average household balance sheet showed no measurable improvement in the measured outcomes within the study windows. The Andhra Pradesh government responded in October 2010 with an emergency ordinance that halted collections and effectively froze the sector in the state. Several large lenders faced liquidity crises. SKS's stock price fell sharply. In the years that followed, the Reserve Bank of India introduced new rules capping interest rates, requiring greater transparency, and limiting multiple borrowing. Globally, the microfinance field shifted emphasis toward responsible finance standards and diversified products such as savings accounts and insurance. Randomized trials continued, and later studies suggested modest benefits in some settings when credit was paired with training or when clients already ran established enterprises. The original nonprofit model persisted alongside commercial players, yet the earlier claim that microcredit alone could reliably reduce poverty at scale received far less emphasis in policy documents. Today, the sector remains large. Global microfinance debt exceeds $100 billion, but operates under tighter guardrails and more tempered expectations. Incentive structures that reward volume over sustained client outcomes tend to erode the very discipline that made an intervention viable at small scale. Complex financial tools interact with local cash flow realities in ways that simple pilot results rarely anticipate, especially once multiple providers compete for the same borrowers. The microcredit experience suggests that any intervention whose success depends on close, repeated human relationships deserves particular scrutiny when capital markets reward rapid expansion. What safeguards would be needed today if a new class of small-scale digital lending were to follow a similar growth path? We'll leave it there for today. Thanks for thinking through this one with me. If you know someone who loves a good cautionary tale, send it their way, and I'll see you tomorrow with another. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. This show comes to you from the NARA Network. If you want another sharp daily briefing, Modern Investing Techniques has you covered. Modern strategies for Canadian and U.S. investors. All our shows are free at naranetwork.com. The Do Positive Pod is the club for people who do something about it. Episodes and the dispatch wall at naranetwork.com, the DP Pod. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.